Okay, welcome to chapter 10. Now, before I get into the content, chapter 10 and chapter 11 are kind of doozies, all right? We're basically covering everything possible that we can think of about property, plant, and equipment and intangible assets. So much so that they broke this topic into two chapters. This first one in chapter 10 is acquisitions about property, plant, equipment, and intangible assets. It also talks about natural resources, which, you know, isn't listed on the front right here, but will be later on down the road. So, because of the amount of information, probably going to be pausing this because it's, time for me to stay hydrated. I might have to take a break or whatever. So if you see kind of little clicks in the video, that's, probably why. So hopefully it won't be too much of a disruption, but either way, let's get into it. All right. So types of assets. I really hate the phrase long lived. I swear I hate it. It's just long-term assets that are something you plan to have longer than 12 months, right? So the current assets are 12 months, up to 12 months. Anything over that's a long-term asset. Long-lived assets. I think what happened was when I was studying for the CPA exam, this woman, Cindy, ruined it for me because she'd just say it and then she'd just start laughing. I don't know. Maybe that's it. Bottom line, pause here. You can look at all of these different information as far as what types of property, plant, equipment, natural resources, and intangible assets are. By now, you should be familiar with it. I get that you haven't had financial accounting likely in a few months, probably a few semesters, because you had it last with managerial. Actually, that wasn't even financials before that. But bottom line is, this is stuff you should at least have been exposed to. We are going to be going through some of the same information that we did in those financial chapters, but we're going to be going into it a little more in depth. All right. So we're looking here at the Microsoft Corporation. This is a note to their financial statement, just a part of it. And it's listing out parts of its property and equipment. So you can see here the things that they list as property, plant, and equipment. You see all of them there. And then you see the total amount of accumulated depreciation and then the net or book value of those assets. Microsoft, again, here's their intangible assets. They have technology-based, customer-related, market-related, and contract-based. All right, they don't give a lot of detail specifically in this little part of what their intangibles are, but just think about it. What technology-based intangible assets could they have? Could Microsoft have? Well, they have a lot of intangible technology-based softwares, things like that, computer programs. I guess that's software too, but customer, they probably have a lot of intangible assets where they're related to certain agreements or something with customers. Same with contracts, same kind of thing. Marketing, they have certain marketing edges. Maybe they have marketing things that are intangible that they have there. I mean, they don't have to disclose specifically what they got because they don't want competitors getting that information, but that's what they have. Okay. This is I'm going to let you pause. I'm not going to read this. All right. This basically just goes into all the description of what the asset is and what types of costs we're going to include in that. You need to know this and you need to be able to apply this, but I'm not going to just sit here and read it because for the most part, we've already discussed in other financial chapters in the past what this is, especially if you had me from those classes. Same thing with intangible assets, what type of asset it is, type of what its description is, and its costs that you're going to include. Again, pause here, take a few moments, read this up, get a good feel for it, and be able to apply it, okay? And in this course, we're going to be dealing with goodwill, all right? We're going to be looking at that, and we're going to be looking at a lot of these in this chapter to discuss how to calculate these and what we need to do, what we need to look at, okay? So costs to be capitalized. Remember, capitalized means that we're going to depreciate it instead of expense it. So any purchase price plus any expenses that is required, necessary, or important to be able to get whatever it is into a usable position. Now, putting it in a storage unit, it's not usable. So having it actually put in established, installed, tested, ready to rock and roll. Okay, that's what we're looking for. And it says here current period is recorded as an expense, future period capitalized. That is recorded initially as an asset, then expense in future periods. I think they're talking about the difference between a capitalized versus I see what it is. If the expense produces a future benefit, but if it's only in the current period. Bottom line is if all you're doing is making it to where the asset can run you're re-oiling it or you're doing repairs and maintenance, that's what it's talking about. It's just saying it in a different way. So if we buy equipment, what are we going to include in it? Purchase price, sales tax, transportation costs, anything to get that piece of equipment to a workable, usable location. Now we may buy that and it may be shipped early and we're not ready for it. We put it in a storage unit for a month. Those storage costs will be included in that cost of equipment. And we will capitalize those costs. Now, the question is though, do you want to capitalize or do you want to expense? Well, again, as this always accounting answers are, it depends. And the reason why it depends is because sometimes there's a benefit to waiting on the expense because you may not have enough of an income to really benefit the reduction in your net income today. So you want to capitalize it so it's less expense. Or maybe you want to expense it because you have too much income and you want it to be lowered. Management plays games like that all the time, trying to push and wiggle their financial position into wherever they think it's going to be best for them for the moment. As the accountant, we need to make sure we're focused on what's best for our external reporting purposes and what truly represents what the costs were to get it into that position. So whether the management wants to put the storage unit costs as an expense or not doesn't matter. We got to put it in the cost of equipment because it cost us to do that before we could get it into a workable condition. So here's a situation. We bought $62,000 worth of equipment, paid freight. What else? Shipping insurance. So it's probably FOB shipping point because we're paying for the freight. We had to do a special platform built specifically for the equipment. Even if it wasn't a special platform built specifically for the equipment, what if we just needed to put in a mount so that we could put it on there to actually work? It's not specific, like you could put other things on there. It's just a mount. You still include that as part of the equipment. If you're putting that mount in as intended to make the equipment effective and use it, it's fine. They just say this so that there's no question. Hey, it's specifically for the equipment, special platform. It makes it sound like it's some kind of specialized piece that can't be used elsewhere if you got rid of the equipment. That's not what they're saying. Okay. After installation, several test runs were made to ensure proper operation. Cost of these trials included wasted materials was $600. All of it's capitalized. All of that's going to be capitalized. What's not going to be capitalized now that the equipment's running, and now you got to clean it. Now you got to oil it. Now you got to put fuel in it. You got to have some other stuff happen to it. All that's going to be expensed as period expenses because you're just maintaining it to make sure it's operating for that accounting period. All right, what do we put in the cost of land? Well, basically anything to actually buy the land. So you're talking real estate commissions, taxes, if they're back taxes, any liens or mortgages that were on that land that needs to be paid to clear the title, any expenses to remove stuff to make it where you can, do whatever you're going to do for it. Those kinds of things are going to be included in land. Remember though, land is not depreciated. Here's another example of that. Delinquent property taxes in this one. If you don't pay it and they won't release that land, you don't get it, right? So you have to pay that delinquent property taxes. Okay. So let's just read that little asterisk here. It says the property taxes included 4,000 of delinquent taxes paid for by Buffalo on behalf of the seller, as well as 2,000 attributed to the portion of the current fiscal year that remains after the purchase date. So there's your key. We did pay the $4,000. It does say of delinquent taxes, but we can only do 2,000. We have to get rid of that 2,000 that's not part of that. Okay. And so you see here, you have the current year property tax. So the 4,000 we're including, but the 2,000 we're not. So it's saying 4,000 of delinquent and then 2,000 as current years. So we're doing the 4,000, but not the 2,000. Okay. Oh, here it explains it. So purchase price, title, commissions, delinquent taxes is that total property tax is 6,000 minus the 2,000 that's for the future. Those are expensed. 4,000 is capitalized. Cost of leveling, removing the old building. Okay. Land improvements are definitely separate from the actual land. We're talking about pavement of any kind, whether it's parking lots, driveways, roads, any fences, sprinkler systems, no landscaping. I think actually, yeah, it'd be land improvement. I think it might be its own thing, but just as long as we understand it's separate than the actual land. Anything vertical. And I know you meant parking lot's not vertical. It actually is, even though it's only a couple inches vertical. Buildings are definitely vertical on land, so their own beast. Again, if you're buying it, any cost to like your realtors, they're selling whatever, and you may buy land and a building, and you have to um, figure out if you know how to separate the costs for that. And you may, if you buy a house in the United States, for the most part, you're buying the house and the land. If you're a company, you got to figure out how to break that out. And it may be that you're getting a deal, like especially during the economic downturns where people can't afford houses, so the cost of the houses are reduced. Hey, but the value of that land and the house might still be higher. So you get an appraiser to come out, give you the fair market value, and you attribute it that way. Or you could base on other things like square footage and acreage and things like that. Natural resources, basically, you're just it's kind of harder, I would say, for natural resources to identify the. I mean, basically, it's whatever you're buying, could be whatever it is and stuff like that. But you got to look at what the benefits are for it as well. Um, but any costs for the purchase price that is getting it to a workable condition where you can actually start extracting or whatever it is you're ripping out. If you're developing an area, any acquisition cost, development, restoration costs at the end that you expect, stuff like that has to be considered. Okay, once you have all these, you use them and stuff. At some point, you're going to retire them. Um, Asset retirement obligations primarily focuses on the I'm sorry, anything that mainly deals with land that you're extracting minerals from. You may need to fix it after you're done. You can't just rip it out and then leave a big old hole in the ground or something like that. You have to reestablish and revitalize that area to make it to where it was as though you weren't there. And so you got to plant trees and put earth back where you pulled stuff out. I mean, there's a whole bunch of stuff you have to factor that in. And then this is more stuff that you have to calculate. Present value calculations. I'm going to try not to have anything that focuses on asset retirement obligations because it is kind of a complicated area. Just know that it exists. We're going to get in here in a minute to look at a few mathematical computations, but that's kind of an area that's you don't know what's going to happen. You're really just spitting out an estimate, and as long as it's reasonable, you're going to be fine. Okay, the Canyon Mining Company paid $1 million for the right to explore the copper deposit on 500 acres in land in Pennsylvania. Should have did Arizona. Arizona's got lots of copper. Our restoration cost paid in 3 years after extraction is complete. Okay, we're thinking cash outflow. The probability is 500,000, 600,000, or 700,000. You have probabilities associated with it. The company's credit adjusted risk-free interest rate is 8%. So what we're going to do is we're going to calculate this based on, and we're going to put this as our capitalized cost. We're going to take the percentage of each one of these for a total amount and then do the present value interest factor of a lump sum for 3 periods at 8%. So we're going to put $468,360 as our capitalized costs for the copper deposit. Right, look, we don't really know. It's going to have to be an adjustment later on, but we have to give it our best shot, and that's kind of the idea here. Our journal entry is going to look like this: debit copper deposit, credit cash for the payment, and then credit the asset retirement liability. So it is a liability, but then as we use it, as we do that, we're going to adjust this. Sorry, I was looking at let's look at something. Okay, so here we have the increase. We have their balance. Each year, our accretion expense is going to have a portion of this amount of asset retirement liability increased. And the reason for that is because we come to know greater how much our amount is as we go through each year. So we have to make these adjustments throughout each year as we get closer to that time, knowing how much it's actually going to be. And then eventually we're going to settle that. We're going to pay the full amount. And even though our asset retirement obligation has increased to $590,000, as sorry, I clicked the button too soon, but this is exactly what I was going into. The loss or whether or not you have a gain or a loss on the situation will depend on how much the actual cost was. So our actual cost finally after the 3 years of extracting was actually $625,000. Well, we've already done the asset retirement liability, so we're going to decrease that, but it's more than what we thought. So we're going to have a loss on that situation where we decrease that. Really kind of a weird situation. It's another one of those where we're estimating, and then at the end of the time, it wasn't the full amount. It's just like a regular asset that we've talked about in the past in my other classes, where you had something, you thought it was this, you had to fix it at the end, make it all work out right. So it usually just chuck it into a loss or a gain somewhere. All right. Intangible assets lacks physical substance. Okay. In other words, when you see a Nike swoosh, I give this example all the time. You don't think that little Nike swoosh on that piece of cloth is worth anything. It's the concept that's worth something. That's what it means by lacking physical substance. It represents something. So this says exclusive rights, but it could be something else. It could just represent an idea, an affiliation, something that derives value. And the thing is how do you put a price on that? I don't know. I don't know. But nevertheless, here are some intangible assets that we've talked about: patents, copyrights, trademarks, and franchises. Usually have a specific amount of time that they are granted the ability to operate those. The second row in this slide shows you exactly how much time each one is. And you will amortize costs associated with that over those lives. Now, there are some intangible assets that don't follow this, such as goodwill. Goodwill is the amount we paid in excess of the fair value of the identifiable assets we acquired. And what we have to do, and that's when we buy a company. Anything in excess is basically our goodwill to giving those people, or basically buying out those people. Okay. Goodwill can emerge from the company's clientele and reputation, trained employees and management team, favorable business location. But for the most part, it's typically buying another company. This is our calculation of goodwill. Take the fair value of the consideration given in exchange for the company minus the fair value of the identifiable net assets acquired. Okay. Here's how we calculate it. Don't overcomplicate this all because it's goodwill and intangible. It's like, oh my gosh. But look, we gave a company $180,000 for this company. We were able to identify assets valued at $250 million, but it had fair value of liabilities that we assumed as 120,000. So the fair value of the assets minus the liabilities was $130 million. Well, we gave 180 million. The company's technically worth 130 million. And so we're going to subtract that 130, which is the fair value of the assets net of the liabilities minus, and then we're going to take that out of what we gave for the company and we have goodwill of $50,000. Okay, it's held as a asset, intangible asset on our balance sheet. Okay. So what happens though as we go through, and I don't know if this is what we're talking about. We're looking at the specific like things that we bought right here as this journal entry. So we received receivables, maybe accounts receivable, inventory, property, plant, equipment, all stuff like that. And so we're putting them all in here as those assets that we bought as debits, crediting the liabilities, and then crediting the cash. This is our journal entry to record this. And in a minute, we're going to talk about what we need to do about goodwill when we are evaluating whether or not it's what we call impaired or not. And we'll deal with that a little bit later, I'm guessing. Maybe on the next slide. Nope. All right. Lump sum purchases. All right. This is the one we're buying something, like I told you, and it's a bunch of items. This one is 10 identical delivery trucks purchased for a lump sum price of $150,000. Now, if I'm just spitballing here, my guess is that if you're buying identical products, all you got to do is take the total cost and divide it by the number of items you bought. And each one's going to have an allocation based on that amount. If you're breaking it down like that, you could just also keep these 100 or these 10 delivery trucks and depreciate them together. In that situation, it's not going to be that big of a deal. Allocate the lump sum acquisition price among the separate items. Yeah, if it's the same asset, if it's the same asset, well, I'm standing by what I said. If they're significantly different, then we have to allocate the price among the separate items. I think that's what it's trying to say. I don't know why it then gives an example of 10 identical delivery trucks, because they're identifiable as separate, but they're not distinguished. They're not different from each other. Let's look at it when it is different. So you're buying land, building, equipment, a patent, and factories or inventory. Sorry. Okay. You look at the fair value of these and you add it all up. You have a total amount, and you're going to look and see how much percentage of fair value is attributed to the land. Well, 330,000 divided by 2.2 million is going to be 15%. The building's percentage is calculated as 550,000 divided by 2.2 million. You come up with the percent that is allocated to each one of these, and then multiply the cost or what we paid for it by the percentages to come up with how much needs to be allocated to each asset. In this case, we gave $2 million. So $2 million times 15%, we're going to allocate land as 300,000. We're going to allocate building as 500,000, and so on down this list. That's how we allocate this. Our journal entry is going to look like this: debit all of the assets, credit the cash or the notes payable or the mixture of cash and notes payable or whatever it is that you did to get these assets. If I had $2 million lying around, maybe I'd buy a company too for $2 million, but I don't have that. This is where I would ask if there were any questions, but again, you're not here. But if you do have questions, please send me an email, because you should be asking me questions. You should be interacting with me, and I should be interacting with you. All right, non-cash acquisitions. All right, what happens when we get something that we did not use cash for? All right. Oh, maybe I jumped to the gun here. Yeah, let's just talk about that. Okay, so what happens? What's situation here? So we buy equipment, but we use a notes payable, right? Maybe we give that note payable to the individual we got the equipment from. Maybe we give the note payable to the bank who bought it. Whatever the circumstance is, we're going to have this equipment. We're going to have the liability. We're going to have interest expense throughout the year. And then by the end of the time the note is due, we're going to pay the interest expense, any payables that we owed, along with the note at its face value. Now, notes are typically, I guess in this situation, we're not paying the interest until the 2 years is up. So we're going to basically be giving each year, and it's 2 years. So we're going to give two. We're compounding. Cool. So in the second year interest expense, we have to add the interest that we accrued in the first year to the amount and then do the 10% on that. That's what we're doing here. That's cool. All right, I got excited for that. So anyway, we're basically paying $50,000 for that equipment, and that's how we're doing it. So please note though, right here, where it's the 41,331, that's our initial amount, but we added the prior interest to it to come up with the compounded interest here because that money was not thrown in or was not paid off. That's why you typically try and pay off your interest so it doesn't jump into your balance there. Because it was a face value of a $50,000 note. Oh, was that this a non? Oh, paying cash. I see. So we had to come up with an effective interest rate. So that's what we're doing. Okay. So we're jumping to the present value. We're looking for the present value interest factor. That's how we're calculating this. I get you. All right. It's more present value interest factor calculations. I'm gonna, again, I know we haven't really talked about those, and we're going to in chapter 5, but we do that right before bonds. These non-interest bearing notes are kind of what we have to use that for, because non-interest bearing notes are basically saying, well, we're not paying or charging interest. Well, okay, you're not, but at the same time you are. So we got to figure it out. And we have to give what we would have paid had it been the fair value, and determine that the notes, the equipment is going to be the actual amount of what the note was minus what the interest would have been. So we have to discount it that way. I hope I'm being clear on that. To try again, let me see if I can make sure this goes. We have to determine the amount by the equipment. We didn't know this. And see, that's what it wasn't really clear on here. It said it was costing 41,323, and that's where I don't understand this example. It's not a very clear one, in my opinion. So we're basically saying, and that's what this is saying, we're giving $50,000 on a non-interest bearing note, okay, for the equipment. Well, that's not how much, because nobody gives out interest-free loans. So what we have to do is we have to figure out how much the actual value of the $50,000 is attributed to the equipment, so that the equipment can be valued at cost. And we have to pull out the amount that should have been paid in interest. And it says here we're going to debit that for the discount on the notes payable, which is fine. So we determine the equipment value by taking the 50,000 and we're multiplying it by the lump sum of the 2 years at 10%, because that's what the bank would have required as interest percent had we done this as a regular note. Therefore, we're going to look up the present value interest factor at 0.82645, blah, blah, blah. Multiply the $50,000. And so our equipment is going to be valued at 41,323. Then we take the difference between those two numbers, the 50,000 that we said we're going to pay and the 41,323 that is the cost attributed to the equipment, and get the difference of the amount in the discount on notes payable as the other debit. It's a discount on that note that we did because we did an non-interest bearing note. Kind of a little confusing. I know that we have some assignments or homework that we're going to do a little bit on those just to kind of cover that. So be patient with yourself if this is something that's a little bit kind of wonky. That you're going to find in intermediate accounting, that's what you get thrown at you a lot, is these really kind of helter, I don't even know if helter kelter is the right word phrase for it, just different stuff, little nuances, little, oh, by the way, what if this happens, what if this little thing happened, then how do you handle that? It is a lot of that if you haven't figured that out by now. But chapter 10 is really, and 11 is really going to throw a lot of little stuff at you. We are going to talk about depreciation and all that other stuff, but it's also these little nuances, little things that come up. All right. So here's our journal entries. We're going to debit the interest expense and credit the discount on notes payable for the interest of both years and make those adjustments there. The discount eventually will go to zero. Our interest expense will equal the total two for each of those accounting periods. That's how we deal with that. Okay. Non-interest bearing notes. Thank you very much. Why don't you guys just not do non-interest bearing notes? Here's another example of said non-interest bearing note. I'm going to let you pause this video. Here we're trying to calculate what is the interest rate. All right. So we know that we're going to pay $100,000. We know the cash price of the equipment is $79,383. So we know the discount on the notes payable is $20,617. What's the interest rate? Well, we got to find that on our present value interest factor table. Okay. Got to go find it on the present value interest factor table. I'm probably going to show you that, and I haven't recorded the video yet for the homework. And no, I've already set it up, so I know that it's in there. But I'll try and remember to show you that on the video. But you're basically just going to go and find uh taking the 79,383 dividing by 100,000, it's 0.79383. Gotta go find the present value interest factor there. Now you can do it algebraically, you can calculate it. It's a bit harder to do because you have to isolate interest, and it's harder to do with the formula that you're given, but it is doable. So anyway, there's that. All right, issuance of equity securities. And you know what, I think I'm going to pause the video and start doing something really quick. I'll be right back. All right, little pause there. All right. This is the pretty common situation. We're basically going to give you stock if you hook us up with something. All right. So what we need to do is we need to either determine the fair value of the assets received by the corporation or the market value of the shares. All right. So let's look at this. Oops. It's there we go. All right. So if we get land, we're going to issue 10,000 shares of its no par common stock in exchange. So we don't know how much really the value of the stock is because it's no par value. We can go and see its market price was $20 per share. 20 times $10,000. It's going to be 200,000. So we're going to issue that. We're going to debit land 200,000, credit common stock, no par value 200,000. So that's kind of how we're looking at that. This looks like we're doing it based on the fair value of the common stock. So $20 per share on the market times 10,000, no par value common stock. Now, if you knew the land and the land was less or more, maybe you'd do it a little differently. So, but just that's kind of how we're looking at that. All right, what happens when we donate assets? What happens if we donate assets? All right, let's find out. Let's see, we got $20 million building. It looks like the headquarters in order to entice Elkhorn to relocate. The building was completed on May 3rd. Elkhorn paid its portion of the cost of the building in cash. So it looks like we're donating 4 million. Is that what we're looking at here? The city agreed to pay 20% of the 20 million. So all right, we're basically being enticed to relocate because the city of Westmont has agreed to pay 20%. That's what it is. So we're the company receiving. I thought it was a donated assets. It's like we were donating it, but we're getting the donation from a city. Is this situation? So we're getting a $20 million building. Okay, that's the cost of the building. We're paying $16 million of that, but we're not paying $4 million of that. We have to recognize that as revenue because we're getting a benefit from something we didn't do. All right. So someone's just basically giving us $4 million, the city of Westmont. Thank you. And we've received that $4 million revenue as in the form of a donation. Pretty cool. All right. Next slide. Don't worry about IFRS. Remember, I do not teach IFRS. I do not like IFRS. I do not care for IFRS. You will maybe have a few questions on the CPA exam on IFRS. I do not care. You can pick those up in the CPA review course. We teach GAAP. I teach GAAP. I only do GAAP. IFRS, in my opinion, is a waste anyway. What's the point of anyway? All right. Decision makers' perspective, present value of future net cash flows is greater than the initial acquisition cost. If that's the case, then you're in good situations. Capital budgeting, you should have picked that up in managerial accounting. Fixed asset turnover is a financial ratio. You need to know net sales divided by average fixed assets. Okay, just know the formula. I give you guys a stuff to bring in with you on your exams and things. If you need this formula, please make sure you write it down and take it with you. I'm not going to go through the calculations. It's just usually a plug and chug. So make sure you know how to do that. Okay. Exchanges. What happens if I have something and someone else has something and we just want to trade? Well, depending on what the situation is, we're going to have to do that. All right. Now, it's funny because I don't know that we call it boot anymore. It used to be, we used to call it boot when I was in college. I don't think we do anymore. I haven't seen that in ages. But anyway, I digress. Record the new asset at its fair value. Remove the old value of the non-monetary asset given, record any cash received or paid, and record any gain or loss. So we just call it, whatever. So if we are exchanging, let's see, Elkhorn traded its old laser equipment for a newer air-cooled ion laser equipment manufactured by American Laser Corporation. Like we needed that information. All right, so we had a book value, which means accumulated depreciation taken out of 100,000, cost was 500,000, accumulated depreciation 400,000. We got to get rid of both of those. And the fair value of $150,000. We, as the ones that are getting rid of it, don't care. Elcon also paid American Laser 430,000 in cash as part of the exchange. All right, all you got to do is plug in those four numbers that you have. The fair value is thrown in there just to confuse you. Okay. Well, I guess I'm just kidding. $150,000 for the fair value is, I guess they are including that into the new equipment. Okay. The old equipment had a book value of 100,000. Why are we? Okay. So I guess we have to account for the fair value in this exchange. I gotta think of that one. This one's new for me. I've never pause this so I don't waste your time. All right, I spent a little time thinking about it, and I think what it is the reason why we include that $150,000 is because it is a value of cost we are giving up. It wouldn't be any different than if we also paid an additional 150,000. I mean, if the equipment that we gave up was $0 and we gave them instead of the 430, we gave them 580. So I think that's what it's saying. So as I thought about it, I'm like, okay, I see how that works. So the new equipment is going to be whatever the consideration is given plus the fair value of the asset given up. Okay, so that I get that. Then you're gonna debit the old accumulated depreciation, credit the old equipment, credit the cash paid. So now once you've done all that, you have to figure it out. Do you have a debit or a credit to balance? If it's a debit, it's going to be a loss. If it's a credit, it's a gain. And that's kind of how it is. I'm gonna see if I can figure out how to work that into Monopoly because I play Monopoly with my 111 students and credit. I'll have to think about that. Anyway, cool. Yeah. What else we got here now? Okay, some situation is different in this. I think our fair value is 75,000 now instead of that 150,000, and then I think we're still paying 130,000. Okay, I don't know why they highlighted that. So our calculation for the new equipment now is 505,000 since it's the cash given, the 430 plus the 75,000. What that does is it means that we have less that we're getting out of this and more we're giving up. All right, we're giving up a $500,000 yet or $100,000 book value plus $430,000 cash. That's 530,000. So what we have now is we got to subtract that out of, I'm sorry, 930,000 is our credits, and 905,000 is our debit. So to make a balance, we need a debit. So it's a loss on that exchange. We did not make as much. Okay. Now, if the fair value is not determined, we just do a very straightforward transaction here. Get rid of the old, get rid of the new, the accumulated depreciation, and calculate the cash, and the remaining balance, the new equipment, is what makes it balance. Okay, so you're getting $100,000 of the equipment as the book value, and then you paid 430,000, so our equipment value is 530. This is what I was thinking of, is if the fair value is not determinable, is why that other one threw me off. I would have presented this first and then got it. So no gain or loss is recognized under these circumstances if there's no way to tell what the fair value of the old equipment is. Or what if you could, but the cost far exceeds the benefit of finding that out? Like, what if it would cost, I know it's $100,000, but some weird thing costs $1 million to have a guy come out and tell you whether that's worth 100,000 or 150,000. Not worth it, right? So you cost benefit would also apply in this, where yeah, we're not going to do that. Let's just do this exchange. And this journal entry is a little more straightforward too. If a an exchange lacks commercial substance, meaning like you're trading nickels and dimes almost. And let's just go through this example here. Newer models of equipment can increase production or improve manufacturing efficiency, causing an increase in revenue or a decrease in operating costs with the corresponding increase in future cash flows. Great. But if it lacks commercial substance, then we're not really going to be dealing with it. Book value of the old asset is used to record the exchange. Just that simple. Fair value, if a loss situation happens, the fair value of the old asset is used to record the exchange. But that's an unlikely situation. Okay. Let's look at something that lacks commercial substance here. Elkhorn Company traded a tract of land to Sanchez Development for a similar tract of land. The old land had a book value of 2.5 million and a fair value of 4.5 million. Elkhorn also paid Sanchez 500,000 in cash. Assume the exchange lacks commercial substance. Land new, debit 3 million. We're getting that by taking the 2.5 million that was our book value, not our fair value, adding that to the 500,000 that we paid. That's how we calculate our new land amount. We don't worry about fair value when it lacks commercial substance. Here's our exchange summary. I would definitely pause the video right now and make sure you understand all of this difference. Okay. Pause that video and write all this down. I'm not going to repeat it. Okay, self-constructed assets. We are building something ourselves, whatever that is. All right. So there's two critical issues we need to calculate or to consider: determining the amount of the company's indirect manufacturing costs, or otherwise known as overhead. Again, you should be familiar with that from managerial accounting, and deciding on the proper treatment of the interest incurred during construction. Okay, let's look at that. Two arguments: construction period interest charges are costs of financing the asset and should be expensed as incurred. Self-constructed assets are not yet ready for their intended use, so interest costs are capitalized. Makes perfect sense, doesn't it? If you think about it, if you have a self-constructed asset, that asset is not in a position for you to use it until it's completed. Therefore, any cost to get it to its completed state must be capitalized, as opposed to something that's already purchased or already constructed, and you're just buying it and financing it and paying the interest. That's after you're started to use it. So we follow the same exact GAAP standard there. Therefore, see, that's the cool thing about accounting is you get these statements from GAAP and you can apply it all over the place. Okay. All right, so let's look at if the asset's used for the company's own use and only interest incurred during the construction period is eligible for capitalization. So like, let's say you use money to build it and stuff. Once you complete it, now you're still paying interest. That's going to be expensed going forward. It's not capitalized. Period of capitalization begins when construction begins and ends. The first expenditure, ends when the asset is substantially complete. Okay, when basically you are no longer really incurring anything, you're complete. Whether you've actually started using it, I don't know that really matters. If you've completed this asset, you start incurring the interest as an expense, and then everything it costs to build the thing. All right, here's an example: interest capitalization. Okay, expenditures on the project, accumulated expenditures for interest capitalization. January 1st, 2027, the Mills Conveying Equipment Company began construction of a building to be used as its office headquarters. The building was completed on June 30th, 2028. So we're talking a year and a half. Expenditures on the project, mainly payments to subcontractors, were as follows. The beginning of the project, they obtained a $1 million construction loan with an 8% interest rate. The loan was outstanding during the entire construction period. Company's other interest-bearing debt included two long-term notes of $2 million and $4 million with interest rates of 6% and 12%, respectively. Both notes were outstanding during the entire construction period. So determine the weighted average accumulated expenditures. So let's take our total accumulated expenditures that we incurred. So you can see at the bottom here, the calculation is what we really care about. Actual expenditures, we had 500,000 at the beginning, 12 out of 12 for the portion of the outstanding year. 400,000. We got to go back here. I'm going back. See here in this section here, we had the January, March, September. We're factoring in, we had 1.5 million, but now we're got to look at the amount of portion for the outstanding time of the year. So our time weighted expenditures is 950,000 of that 1.5 million. Okay. And our total accumulated, or our average accumulated expenditures is 750,000. So with that, we're going to take the 950,000 and multiply it by 8% and get $76,000. That's going to be what we're going to, I'm sorry, what we're looking at. I'm sorry, I was getting mesmerized there. So when we're doing, this is the weighted average method. Would have been nice if we would have said that at the beginning, because I was starting to get confused. Is used when outstanding debt is not specifically designed for a construction project. Why do we care about that? Oh, it did say determine the weighted average accumulated expenditure. I apologize, I missed that part. So the weighted average then is we have the total of 6 million because we have those other two loans. So we do the interest rate on those, 600,000. 600,000 divided by 6 million is going to be that 10%. So our interest capitalized for 2027 is going to be the $95,000 because it's 10%. Even though our accumulated expenditures at December 31st was 76,000 for the interest. So let's look and see what we're going on now. So our actual interest, $680,000. We're going to use the lower amount, 76,000. Step 3. Would have been nice if they would have put those steps in order for us to read first. So we determine the weighted average accumulated expenditures. I've gone back. Determine the weighted average accumulated expenditures. So time weighted expenditures was the $950,000 for those 3 transactions. Then we calculate the amount of interest to be capitalized. The specific interest method is used when the rate relates to a specific construction loan. So our interest capitalized for 2027 was 950,000 at 8%, 76,000. So our cost accumulated expenditures at December 31st, 2027 is 1.576 million. But our weighted average interest method is used when outstanding debt is not specifically designated for construction project. So we calculate our 2 loans and we get the percentage interest on them and then calculate the weighted average rate. 600,000 of interest divided by 6 million, it's 10%. So our interest capitalized for the year is the $950,000 times 10% to get $95,000. All right. Then our interest capitalization is we compare the calculated interest with actual interest incurred, and we are using the lower amount. So our calculated interest of $76,000 will be used instead of the actual interest, which was $680,000. All right. So I had to go through that again, but I wanted to make sure you understood it because it was a little off for me as well. But now we got to do it for the second year, right? Determine weighted average accumulated expenditures for 2028, the second year. So our accumulated expenditures, we've already calculated that as 1.576. That was our 1.5 million plus the lower of the 2 interests, which was $76,000. We have 2 more expenditures, 600,000 and 300,000. Now we're going to take those actual expenditures and multiply them by the portion of the year by end of the project, which the first one is the full 6 months. The second one is 5 months, and the last one is 2 months, but it's out of 6 months because we're only doing it for 6 months. We got it done June 30th. So step 1, we determine the weighted average, 2.176. 2.176, and the specific borrowing of 8%. Portion of the year outstanding was half a year. Coming up with interest capitalized for 2028 of 98,800. The actual interest was 340,000. We calculate that again, half the year this time. So our lower amount is 98,800. We're picking the lower of the 2. A lot of fun, isn't it? A lot of fun. So I'm telling you, there's like these little things that were just thrown at you right now. Property and equipment, in part, company capitalized interest expense is part of the cost of construction of facilities and equipment. Interest expense capitalized, the fiscal year is 22, 21, and 20 was 49, 49, and 63 million respectively. Okay. Oh, this is a disclosure note. I apologize. I thought we were doing another problem. It's a note in the financial statements. Overhead allocation. This should be familiar. You should be familiar with how to allocate overhead if you've done managerial accounting. Okay, what happens with you do with research and development? Okay, it's basically you. This is the funny part too about just side note on companies. Whenever they find an economic downturn, this for whatever reason one of the first things they cut is research and development. It's like, hey, let's cut our head off so that our body will live. It's the dumbest thing ever, but instead of looking inward and say, you know what, I'm getting paid $5 billion a year, maybe I ought to cut $1 billion out and we can do some more with that. I digress. Sorry, I apologize. Anyway, so how do we determine R&D costs? All right. Things that are going to be included, it's going to be your salaries and wages of the personnel, materials, services, anything that is there to create new things. Any assets that you're purchasing for anything specific. If an asset has an alternative future, then we're going to look at the depreciation and amortization during those periods you're using it for R&D. Otherwise, the whole cost is considered an R&D and expensed immediately. So research and development expenditures, you can pause this. These are examples and just read through those examples. Oh, you know how to give you guys your word about now, right now. I was getting on a roll and having a great time here. I'm going to pause the video. I can't see where I put it. Hey, I found it. The word is mummy, as in like Halloween time mummy. Ummy. Mike, umbrella, Mike, Yankee. Mummy. Remember to put that word in the quiz and you get your points. Hot dog. Okay, and you should have been pausing this anyway to read up on all this stuff. Okay, so here's our research and development. The project resulted in a new product to be manufactured in 2028. Patent was filed with the U.S. Patent Office. Amortization of the patent's filing and legal costs will begin in 2028. Equipment purchase will be employed in other R&D projects. Depreciation on the equipment for 2027 was $500,000. So our journal entry to record our R&D expenses for salary, supplies, and payments to others is going to be listed up here. So we have our salaries of 10 million, 3 million. That equipment is going to be sorry, depreciation on equipment was 500,000, so that's not. I wonder. I think it's because we're going to move it to another project. We're not going to employ the whole amount. Well, anyway, we're putting everything in here minus the patent filing fees because we're going to put that towards the patent. And then we're going to do the 5 million, I guess, on its own to equipment as is illustrated here. And we're going to depreciate it for an R&D expense for the depreciation with that. And then the patent gets its $100,000. So that's your journal entries for that one. So 10 million, 3 million, and then so sorry, let's go back here really quick. So the 14.2 million is your 10 million, 3 million, 13, 14, 2. So the top two numbers and the bottom number are all going to be debited to R&D expenses and credited to cash. Then we're recording the purchase of the equipment for the cash, $5 million. Then we're going to record the expense of the R&D accumulated depreciation or the depreciation expense to this R&D expense right now. And then the patent gets the $100,000. So I just want to make sure you guys understood how this was all getting situated. Now, when I'm going backward, because this, where is it? Here it says assets purchased for a single R&D project. So that's why we're only debiting the depreciation for the year it was used in the project. If it's multiple R&D projects or something else, then we're only going to do the depreciation. Otherwise, we do the full cost. That's what I was trying to put my arms around. Okay, so here's a kind of a overview, I guess, or whatever. Expenditures recognized here. So you have capitalizes equipment, the 5,100,000 is patent, and the rest to the R&D expense. Don't worry about IFRS. Software development costs. Okay, you're building software. Welcome to Microsoft, right? Costs incurred during preliminary project planning stage or R&D. Anything that is used during the application and development of the software is capitalized as the software asset. Cloud computing costs. This is a new one for me in this world because we didn't cover this when I was taking this class. But the customer has a contractual right to take possession of the software. Oh, wait. Costs of cloud computing arrangement are treated as a purchase of an intangible asset if both the customer has a contractual right to take possession of the software without significant penalty. Why is it called cloud computing? This is just talking about software. Customer could run the software on its own or with an unrelated vendor. If either of these are not met, the arrangement is treated as a service contract. Okay. Why are they talking about cloud computing? That's weird. But that just threw me off. I thought we were talking about actual cloud computing. Bottom line is that if I make software and or I guess it is in this case, they're saying cloud computing. Like, okay, so you're going to use my software. If you could run this software with somebody else and you have the contractual right just to take the software and just use it, then you purchased an intangible asset. But if not, like if the customer is not able to take possession of the software, or the customer could run the software on their own with an unrelated vendor, then it's a service contract. I'm trying to think of a good example of this. If let's take QuickBooks. They have QuickBooks Online. That's a service contract because I could buy QuickBooks Desktop. So that's a service contract. But if, let's say, I contact somebody and they develop a software, an accounting software program that's specific for me, and I can't run it with an unrelated vendor because it's just specific to me and it's all on its own, and I have a right to take the software without any significant penalty and use it, then I've bought an intangible asset. That's kind of what they're talking about. Okay. R&D performed for others. It's capitalized as inventory. Basically, you're creating an inventory, creating something you're going to sell, and anything you're going to sell is inventory. R&D and business acquisitions. Capitalized at fair value. If you bought it from another, if you're buying basically R&D purchased in business, we're buying a company and we get their R&D. We're capitalizing the fair value if it's developed technology, if it's in process. We're going to do it as an intangible asset. It's an indefinite life. And then the one that's developed, it's finite. This is where we get into all these like little things. And if you're wondering why I'm kind of slow with it, it's because I've literally never dealt with startup costs, which I think we're going to talk about next. R&D, but it's stuff that you want to know. And so I'm a little less comfortable talking about a lot of this stuff just because I literally never did this in my real life. But you do know, if you're taking the CPA exam, you want to be an accountant, maybe you want to go and do those things. So it's not things that you shouldn't know. I'm not wasting your time if that's what you're wondering. So any kind of startups you do organize, organization or whatever, you can include as you're not capitalizing them, basically. I'm sorry, you're not capitalizing. I was thinking of that because I did review books of companies that or not books or financial statements where they do have organizational costs. And so I wonder if that was a special situation because of the circumstances, but I do know that some do hold that as an asset. But that said, to expense it. Oil and gas accounting. Okay, we've talked about depletion and stuff like that. If we're exploring though, is what this is the appendix. We just hit the appendix. I'm not going in the appendix. This is like you're drilling dry holes. I mean, yeah, guys, come on. That's it. That's a lot. That's a lot, guys. I know that. And chapter 11 is going to be similar too. I don't apologize because it's just what it is. We have to go through it, but it is a lot to take in. It's a lot to absorb. Take your time. If you have any questions, again, call me, talk to me, not call me, text me, email me. I mean, and I'll be happy to kind of go over some of these problems with you, but I will be doing a video on the homework. So please look for that. And otherwise, we'll see you guys in the next video. Take care.